What's up, guys? Welcome back. A couple weeks ago, I made videos on the covered call and the cash covered put as well. And it's getting some amazing feedback. Views are up, but I keep getting the same concerns over and over again on both videos that I want to address today. Those concerns are, number one, the collateral. On the covered call side, some people are like, hey, Brad, I don't have 100 shares of a stock. I can't do this. And on the put side, people are like, well, I don't have the cash to secure that. Like, I can only do it with cheap stocks, and I don't like cheap stocks. They're sketchy, so I really can't do this, and I totally get it. The other concern is that with a cash covered put, there's a lot of, risk involved. The downside risk is there. You could potentially lose a lot of money to only get a little bit of premium. And some would argue you're not losing money because you are going to have to purchase those shares. But today I want to talk about something called a credit spread, and how you can use a credit spread on the put side and on the call side to limit your downside risk, as well as trade a couple options without needing a ton of cash in your buying power for collateral. Now, before you watch this, you need to understand what a covered call is and what a cash covered put is. I will leave a link in the description. I have videos on both, so go back and watch those, please. If you don't watch those first, this is going to make no sense whatsoever. And guys, please also understand that trading options has inherent risks. There are a ton of risks. You're going to hear from people, especially index fund investors like myself, that trading options is probably not the best, most efficient way. It's kind of like a YOLO strategy. I personally do it with money that I have after I have funded all my retirement accounts, paid all my bills. I could lose all my money and my life would not change at all when trading options. So please think about that. Do not just watch this video and think that I'm just YOLOing money. This is my lowest priority when it comes to my investing. So for some context, I'm going to show you exactly what a cash covered put is first, so I can show you what those risks are that I'm talking about, and then I'll show you how we're going to mitigate them. So let's say, for example, you just found out Kanye's on board with Gap. You've been following Bruce Wang's video. You're a part of the Wang gang, and you're all in for Gap. The ticker symbol, GPS, okay? So you're like, I want to trade some options because I think Gap stock is going to soar. So what I'm going to do is I'm going to sell a put against it, collect some premium, it'll expire worthless, and that'd be great. But then in the back of your head, you're thinking, well, what if Kanye comes out tomorrow and says F Gap and the stock price plummets? You could potentially take a huge loss if it does not expire worthless. This would be a great example to use the credit spread. It's like when you're cautiously bullish on a stock. You're pretty sure it's going to go up, but you really don't know. And a stock like Gap is perfect for that right now. So let's take a look at Gap and what the options chain looks like. As you guys see, if you see my options here, I have credit spreads, I have calls, I have puts. If you want a full look at all the options moves that I'm making, guys, inside my Discord for my Patreon members, we talk options all day. We talk investing, dividend stocks, real estate, everything that has to do with money. Right now, the chat is just going crazy. If you want to consider being a supporter of mine, the link for Patreon down in the description below. Like I said, you can get all the information and behind the scenes look of exactly what I'm doing. So if I click on Gap right now, if I was just going to sell a cash covered put, I would click trade options. I would make sure that I go to the sell side because we want to sell to collect premium. Buyers pay premium, sellers collect it. And I would put a put in at, say, $18, just below the share price. Now for doing that, I would get myself a $37 premium. So you're like, sweet, $37 in premium, 37 cents per share. I'll take that. Then you go to continue. You type in the one contract, which was the 100 shares, which brings that 37 cents to $37. You review the order, and then when you're looking at it, you're like, whoa, I need $1,800 in collateral to make this move. Now, there's something called a naked put. I'm not even going to talk about it. Don't do it. That's when you make these trades and you don't have that money and you'd have to borrow the money to pay it later. Don't do it. Cash covered means that we have the cash in our buying power, $1,800 to do this. Now, some people don't. But then this also displays the potential loss. If Gap stock went all the way to zero, and I'm going to illustrate this in 1 second. If Gap stock went all the way to zero, you're going to lose $1,800 because you're still going to be required to buy 100 shares at $18. It's going to be worth zero, but you have to pay $18 per share for it. that's not a good thing. So let me just show you what I mean by that profit and potential loss before we move forward into the credit spread. So I don't think I've ever used a digital whiteboard on this channel before. If you guys like what I'm about to do here, let me know, because I always want to use it, but I'm always a little skeptical. All right, so what we were just talking about a gap put at a strike of $18, and it was going to get us a premium of $36. So now the maximum profit you can take is $36. So let's say 6, 12, 18, 24, 30, $36. So if I came out to this $18 strike price and went up here, this right here would be the maximum profits that I could take. And this would be if the contract expires worthless. So this is max profit. Now, how do we find our break-even price? Where are we at zero? Well, we are at zero at our strike price minus our premium. So if I go to break even, I would say $18, that's our strike price, minus the 36 cents of premium that we took. So our break even price is going to be that difference. So as long as the share price stays above $17.64, we are going to profit from this trade. That would be somewhere in this neighborhood right here. So we see once it dips below our strike, there's going to be diminishing profits to my break-even price. But now this trend continues all the way down to zero. So our max loss potential is going to be $1,800. So here's where people are saying, well, you're putting up $1,800 to only get a premium of 36. That doesn't sound like a really great deal. This loss side is so big. So what we're going to do is we're going to use a credit spread to mitigate this downside loss. So essentially, here's what we had before. And as you can see, the premiums are changing, guys. The markets are live right now, so bear with me as far as the numbers are concerned. But what we're going to do now is we are going to buy a put at a further strike price out to hedge against our losses. If it dips down, right? If we get assigned on regular cash covered put, we have to buy those 100 shares. Well, when you buy a put, now you're giving the option to sell those shares to mitigate that loss. So what I'm going to do is I'm going to stay on the put side and I'm going to go to buy. Now what I'm going to do is I'm going to buy something to hedge that loss. You can go as far out as you want. The further apart, the more premium you're going to keep, because when we buy, we give back premium. I'm just going to choose the next one down, $17.50, and I'm going to click this right here. Robinhood is going to recognize this as a put credit spread. It does all of the math and everything for you, and essentially you're going to get paid, in this case now, $39, but you have to give back $21, so therefore your total credit is going to be $19. This now is your max profit. So what you've done is you've diminished your profits down, but you've also mitigated that downward loss. If we look, the collateral needed for this is only $50. Okay, all it is the difference in spread, and that's not even your max loss. Your max loss is going to be that difference in spread, the collateral that Robinhood is going to keep, as well as minusing the premium that you collected. So let me show you now how that graph is going to change. So this right here was your sell. Now what I'm going to do is I'm going to buy. And I'm going to buy further out of the money at $17.50. But now I'm going to give back some premium, right? Buyers pay premium. To keep numbers simple, I'm going to say that I had to give back $20 of that. So now here's why it's called a credit spread. I'm going to get $36 for selling the put. That's going to be a credit. But then when I buy the put, I need to give back $20 as a debit. So my overall, I am going to credit $16 in premium from this transaction. And that's going to be my max profit. So if I redraw my max profit, now I have a situation where 6, 12, 18, at my $18 strike right here, now this is my max profit. But I've also mitigated that loss, and here's what I mean by that. My max loss now is going to be the difference in the strikes that I choose. So right now, this is 50 cents for a contract is 100 shares, so that's going to be $50. So my collateral is equal to $50 minus the premium that I'm going to collect, $16. My max loss now is only going to be $34. So instead of this going down all the way to 1800, now I could say 6, 12, 18, 24, 30, 36. My max loss now becomes somewhere in this zone right here. Now my break even is also going to be moved to a higher price because I took less premium. So if I connect these two dots, we can see that my break even price is going to be closer to 1775 as opposed to before it being 1764. But everywhere inside this zone here, this is your profit side. Where max profit happens if it expires worthless, max loss is if it dips below the 1750. So this is max loss. Where, like I said, the old graph looked like this. I came up and had a little bit of profit, but then this could have went all the way down till it met zero. So this was the potential loss, and this was the max profit, which is why some people don't like it. So essentially what I've done is if it stays above $18, I'm going to collect $16. Somewhere from here to here, I'm going to collect a little bit of profit, but not as much as $16. Then, once I get below this, till I get to my next strike of 1750, which really should have been over here, this area right here is going to be my beginnings of my losses, and then my max loss happens when it dips below 1750. And guys, you can do the same exact thing on the call side as well. If you thought the stock was going to go down and you wanted to expire worthless, I'll just show you what that would look like. What you do first is you would first sell the call and collect a premium. Let's say $20. I think it's going to stay below $20 by September 1st. I would click this. To hedge it in case it goes up, 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 and I don't want to lose on too many capital gains, I would then turn around and buy further out of the money at $3. I would collect the difference in premium. According to the bid-ask price, I would collect this right here would be $3, and that would be that. If it shot way, way up, I would get those shares at that price that's way, way up. If it doesn't and it stays worthless, I'm good to go. Guys, I use this strategy to make over $500 this week alone in premiums. Like I said, my Patreon members are getting full access to all the trades I do. We talked about it all weekend long before we made some trades. Some people got in on their first credit spreads, their first calls, their first puts. It's an awesome little Discord chat we're going. Like I said, link down in the description below. If you'd like that whiteboard action, let me know. I'll use the digital whiteboard to help illustrate some more things that I'm doing. This right here is that cash covered put video. If you need to start there, you want to go back and refresh. And down here is the entire wheel strategy where you see the covered call side as well. And then some of my live purchases to see exactly how that's happening in real time. Until I see you guys in the next one, stay positive, work really, really hard. Always be kind to other people. Hope you have yourself an amazing day and an even better tomorrow.